Let's get your week started. Live from New York City this morning. Good morning, good morning. Equity futures just about unchanged on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, earnings season just around the corner. Chairman Powell on track to hike once again, and President Biden touching down in Europe. We begin with the big issue, inflation data, up next.
We got CPI.
The June CPI report.
Watch CPI.
Let's see what the data is telling us.
It's going to be a softer number.
Quite soft.
Squeezing the last little bit of water out of this inflation sponge is probably going to be more difficult than a lot of people expect.
You have risks that inflation actually increases.
Some reason to believe that inflation will be too sticky.
Core is going to be critical.
Core inflation has been very sticky.
Depending on what we see from the inflation data next week, we could see another rate increase.
It's going to be pretty hard to stop the Fed from hiking.
They're worried about inflation.
They really feel that they got to get this inflation down.
It's arguably going to require a recession.
Substantial amount of damage.
They're going to keep at it.
There's still a long way to go in terms of bringing inflation back down to the Fed's target.
Joining us now to discuss BlackRock's Amanda Lynham, Invesco's Brian Levitt. Amanda, first to you and to both of you, thanks for being with us. Amanda, I guess my first question, are we still on course for a hike this July?
Good morning, Jonathan. Thanks for having me. It's great to be with you. We think we are. And as you know, and as we've talked about it, I think over the past few months, for us, we've acknowledged that we're probably closer to the end of this hiking cycle, obviously, given the significant cumulative hikes that have already been achieved. So whether we get one or two more hikes throughout the course of the year remains to be seen. Probably the path of least resistance is for a few more hikes. But I think the more important consideration for corporate credit investors is how long we stay in this tight monetary policy regime. We think that we'll stay here for a while, and that certainly has implications for both credit risk premia, but more importantly, defaults and downgrade risk. But I think that's probably the metric to watch for corporate credit investors is not necessarily how many more hikes we get over the next few meetings, but rather how long we stay in this kind of restrictive policy environment.
We need to get through the first two meetings first. July looks like the debate is almost over. Inflation data just around the corner. Before we get there, then it's on to September. What happens in September? Andrew Hollenhorst, the City, says let's go. He says a rate hike at the end of this month is highly likely. It's priced in by markets. We continue to expect another 25 in September. This is from Morgan Stanley. They say no. They say we continue to expect a move in July. The incoming data will not meet the bar for the Fed to deliver a hike in September. The labour market remains strong, but there is continued evidence of slowing that we expect to persist. Brian Levitt, first one to you. September, which camp are you in at the moment?
I don't think they're going to raise rates in September. I mean, obviously, things can change between now and then, but you're going to have the headline number down in the low threes. Now, I know that core remains sticky, but a lot of that is shelter. And if you look out at what's happened to home prices or rentals, apartment rental prices, they've come down a lot, and that usually lags in the CPI shelter. So I think you're going to see the core prices come down, which is good news. Plus, the economy is slowing, and you're already starting to see banks have some write-offs. I mean, this is classic, end of cycle type stuff. And the Federal Reserve has already raised rates a substantial amount over a very, very short period of time. I mean, can't we just wait and see what the lagged effects of all of this is going to be? We've never had an environment where inflation has come down the way it has and then skyrocketed. I mean, we know directionally where it's going. The break evens are very low. Inflation expectations are generally contained. I think this is the last one. Obviously they're data dependent, but I would like for this tightening to be over. Your words, classic end of cycle type stuff. Amanda, do you see classic end of cycle type stuff in credit right now?
Not in terms of valuations, but we do see it when we look under the surface. I think the two things that I would highlight are the divergence in default trends against those pockets of the corporate credit market that are very interest rate sensitive, so leverage loans. We're also keeping a close eye on commercial real estate. And then the fixed rate counterparts where the defaults have been relatively more contained. Actually, if you look at that spread of the trailing 12-month default rate between the leverage loan universe and the high yield bond bond universe. Leveraged loans are outpacing high yield bonds in terms of defaults by the most since 1996. That's when the Moody's data began. So you are seeing that manifest in terms of stress in that interest rate sensitive pocket of the economy. But as you know, we don't view the high yield market as immune. In fact, if you were to look at the universe of high yield borrowers and you look at the difference between the current coupon that they're paying and where they would need to refinance if and when they choose to come to market, for a large part of the economy, that spread is either 300 basis points or 400 basis points or even more. And so when we do think about late cycle risks and kind of headwinds to corporate credit quality, those are the things we're keeping an eye on. I would say that despite the outflows from the market, despite all of the talk about downside risks to growth, valuations really aren't reflecting that. High yield spreads are below 400 basis points, as you both well know. And so I think it does warrant treading carefully. The other kind of one thing I would point out is that there is this tug of war against this late cycle backdrop, as I think Brian correctly called it, in returns. And for all of the talk about loans being interest rate sensitive and defaults really outpacing high yield bonds, loans have outperformed on a total return basis thanks to their floating rate nature, obviously. So there is a constant tug of war that we need to monitor between the fundamental headwinds and what we can actually achieve in terms of returns. And I think being nimble and responding quickly is going to be the key for the second half of the year.
Amanda, let's tease that out a little bit more. That spread that you identify, what people pay, companies pay on their debt right now, those coupon payments, and what they'd have to pay if they reissued debt right now, only matters when they have to reissue debt. And that breathes some life into the conversation, the debate we were having a little bit earlier, how long the Fed is going to stay at these levels. That will have implications when companies come back to market. So with that in mind, where's the maturity wall? How far out into the distance is it, Amanda?
Yep. So the maturity wall becomes significant for high yield bond issuers in 2025, and it really doesn't let up until 2028. So it's a really heavy maturity wall. I would say two things. One is 2025 sounds very far off in the distance, but as we know, high yield corporates typically don't let their bonds become current. So they don't let them become maturing within the next 12 months. So it's realistic to think that in 2024, corporates will start to address those upcoming maturity walls in earnest, if not before, again, given some of the downside risks to growth, and we know that the primary markets can be choppy. The other thing I will mention is that there's a subset of capital structures, and a lot of those line up with the sectors like in telco, media, cable, in pharma, in retail, where there is a big disconnect between the current coupon, thanks to proactive refinancing in 2020 and 2021, and the current yield where they would refinance. Some of those capital structures just might not be economic in a higher for longer cost of capital environment. So leaving the nuances of the near-term maturity walls aside, does the capital structure make sense in a period of higher cost of capital and slowing growth, below trend growth? And so that's something to keep in mind. And I think the key takeaway for investors is that while we do not expect defaults to revisit even the peaks of COVID, we do think that there will be more dispersion under the surface, and we do expect a modest uptick in defaults throughout the next several months.
Brian, that's the big question, isn't it? Higher for how much longer?
I mean, at some point, this Federal Reserve is going to have to normalize the yield curve. And the way you normalize the yield curve is not typically with a jump in long rates. You know, this recent move up to 4 is obviously on better than expected economic data. But again, we still haven't seen the lagged effects of all the policy tightenings. I would expect the 10-year to start to move back down to where it was and settle in there, which means you're going to be in a deeply inverted yield curve environment. I don't know how long that can persist. I would expect that, you know, as the economy slows, which, by the way, I think the equity market did a good job of pricing last year, as the economy slows, and the Federal Reserve is going to obviously back off the tightening stance, but at some point is going to have to start working to renormalize the yield curve. And that's typically how this plays out. I don't suspect this to be any different. So the question is, what does it all mean for investors? Again, the market went down 25% last year, which is very much in line with more mild recessions of the past, like an 81, like a 91. Markets are up, what, 17% since inflation peaked in June? That's pretty standard. That's the way these things play out. And typically markets do very well after the end of tightening. And so I would, there's some challenges ahead with a slowdown in growth, but if you've got a 1-2 year horizon, I think markets are going to do well, as they typically do in the aftermath of Fed tightening.
I've got a time horizon of about 20 minutes. We're 20 minutes away from the open and bow. Tons of economic data this week, tons of Fed speak too. CPI just around the corner. Let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, it is a big week for President Biden. He's in Europe, but keeping an eye on what's happening with inflation here. The CPI report out Wednesday is the big deal of the week. We also get PPI, which has been running lower on Thursday, and jobless claims. And then Friday, we get the import price index and Michigan sentiment. So things back off a little bit as the week goes on. But it's also a big week for Fed speak. We're going to be watching the CPI. And we want to know what the Fed thinks about it, because here's where they are. At the moment, the headline CPI has fallen below the Fed's target, but core has not. And it's core they want to see go down. So how far will it fall? Bloomberg Economics thinks we go to 5, which puts it about even with where the Fed's numbers are right now. But if the Fed goes up, that will put more downward pressure, they hope, on core inflation. We will get some immediate reaction because we get a lot of Fed speak this week. We especially get some information today that will be a little bit different in terms of the impact. Michael Barr, the head of supervision for the Fed, is going to be laying out some of the new bank regulations that they're going to be talking about. But Daly, Mester, Bostic, and then on Wednesday, a whole host of them talking about their reactions to the economic data that we've had. Thursday is very interesting. 1 year ago today, John, here at the Rocky Mountain Economic Summit, Christopher Waller laid out a view of the economy that said we can have a soft landing without higher inflation. And you remember that triggered a paper from Olivier Blanchard and Larry Summers saying that Waller was wrong. Then Waller responded to that, and we got a little economic food fight going. A year later, we have inflation coming down, and so far, no problem with the unemployment rate. So let's see if Chris Waller takes a victory lap this week.
I'm going to make a note of this for next year, the Rocky Mountain Economic Summit. Mike McKee in a log cabin with a burning fire, talking about economic data. Where did the rest of us go wrong? Mike, thank you, sir. Brian Levitt, Mike went through the data in the week ahead. Bank earnings on Friday too. JP Morgan, Citi, Wells Fargo. What are you expecting to see in those numbers?
Yeah, we're starting to see a moderation, some challenges for the larger banks. I mean, nothing that would take you back to, past crisis of yore, but you would expect that in a slowing environment, investment banking challenge. You're seeing some bank write-offs now, which have picked up. So I think the critical point is to say that there's, anytime you see tightening like this, anytime you have a slowdown, the banks come under some challenge. The good news is, and investors could probably breathe a little bit easy, is that these banks are well positioned, well capitalized. They're not sitting on mountains of bad debt, but these are parts of the market that tend to not do as well in the later part of the cycle.
Amanda, what happened to the credit crunch?
I agree with a lot what Brian said in terms of pulling back in activity and lending. I think as it relates to the March disruption, certainly the outcome of that was much more benign than I think many market participants, including ourselves, anticipated. That's a good thing. I don't think, however, that it means that it's over. If we read what the companies are saying, both in last quarter's earnings and just in some of the data, we were already seeing a tightening of lending standards heading into March. We expect that to continue. Banks are talking about higher cost of deposits. Some banks are talking about prioritizing existing customers in terms of lending relationships. And so I do think for a subset of the economy that's looking for funding, the banking channel may not be the place where they can have as much success going forward. We think that opens up a pocket for areas of the market, say for private debt, for example. That certainly also extends to the private real estate market if we think about the longer-term headwinds facing the commercial real estate market. So I think in a nutshell, it means that there's probably a slow burn happening in terms of a pullback in credit availability. But the good news is that we didn't have the adverse scenario that maybe we would have thought that we were facing when we were in the thick of it in March of this year.
Massive change in just a few months. Amanda, Brian, this conversation's going to continue. Amanda Lynham there. and Brian Levitt. Let's get you some movers going into the opening bourse. 16 minutes away. Here's Abby.
John, with the futures down ever so slightly, let's take a look at one of the big tech names that is dragging. Microsoft heading to a second down day in a row, falling more than 1% on Friday, down about 0.8%. This, of course, going into earnings season, worries of valuation and that perhaps the bar is high. Rivian Automotive, on the other hand, up 2.6%, heading to a potential 9th up day in a row. If it closes higher, it will be the longest record winning streak ever. And of course, all of this having to do with the fact that they did confirm about 2 weeks ago 50,000 vehicles to be made this year. And Amazon has now made $1.8 billion on their stake. And then finally, Charles Schwab up 1.4%. We have two brokerage houses having positive comments and providing price targets of $73. JMP Securities in particular has upgraded Charles Schwab to a market outperform, and again, a $73 price target ahead of their earnings report this week.
Interesting. Abby, thank you. And ahead of the bank earnings later this week on Friday, JP Morgan, Citi, Wells Fargo, on to the rest of them through the next week or so. For those of you not familiar with the arc of earnings season, the banks go early, then you get to the tech names. We'll get to the tech names later on this month. Coming up next on this program, President Biden touching down in Europe.
Holding NATO together is really critical. I don't think there is unanimity in NATO about whether or not to bring Ukraine into the NATO family now, at this moment, in the middle of a war.
That conversation up next.
We're in a situation where Ukraine continues to be brutally attacked across the board by munitions. It took me a while to be convinced to do it. But the main thing is they either have the weapons to stop the Russians now keep them from stopping the Ukrainian offensive through these areas, or they don't. And I think they need them.
President Biden meeting with UK Prime Minister Rishi Sunak ahead of the NATO summit, discussing financial and military aid to Ukraine, including Biden's controversial plan to send cluster munitions. Most NATO members objecting to that decision as Biden makes his way to Lithuania. Let's get to Katie Lyons now, first of all, for more down in Washington, D.C. Katie, I want to talk about that specific point becoming increasingly controversial.
Yeah, that decision on Friday to provide these cluster bombs is, of course, the U.S.'s response to the fact that Ukraine is running out of ammunition. But it was not without pushback, even from those within the U.S., many Democrats expressing concern over that decision. The concern, of course, being the potential for civilian casualties and collateral damage as a result of that. Now, Ukraine's ambassador to the U.S. was actually on one of the Sunday shows over the weekend, promising that Ukraine will use this responsibly, but it still remains a concern. Of course, this will be a broader issue at NATO, the supplying ongoing of ammunition and weapons for Ukraine. But the other issue that will be a subject of the alliance when it meets for this summit is whether or not Ukraine ultimately should join NATO. We were just hearing President Biden there expressing concern because, of course, the articles of the alliance dictate that an attack against one is an attack against all. And given Ukraine is actively engaged in a war that risks drawing all the other members into this conflict, which is why it's a tough ask. But still, Ukrainian President Volodymyr Zelensky is going to make the trip to Lithuania to try to make the case that they should be allowed into this group after the war. Another question about whether or not NATO should expand is Sweden's inclusion in this alliance, accession to the alliance. Of course, that is something that is currently being held up by Turkey. They have concerns about Swedish essentially the opinions there of Muslims. And we do understand that President Biden, on his way to the UK yesterday, did speak by phone to Turkish President Erdogan, discuss the prospect of purchase of F-16s as well from the U.S. to Turkey. We'll see if that is enough to kind of grease the wheels here to actually get Turkey to drop its opposition to Sweden joining this alliance, John.
We can head to the UK right now, Katie, and catch up with Guy Johnson. Guy, Katie went through 3 points there. The first point, cluster munitions. The second, NATO membership for Ukraine, and then Sweden as well. Did those issues come up this morning, Guy?
They were all discussed. Clearly, the issue of munitions, I think, is front and centre. The UK has pushed back a little bit on that. I think there is an understanding of why the US is making the decision that it is making. It is not a decision that the UK is going to be making in terms of the provision of those weapons. The issue of Sweden, the issue of what happens with Turkey are difficult decisions I think that NATO needs to think about. Turkey bought the S-400 weapon system, which put it at odds with the supplying of U.S. weapons. The Russian-made S-400 weapon system, the air defense system, is something that the U.S. doesn't want in the same arsenal as its own weaponry. And I think the linking of this obviously is very interesting from a Turkish point of view. The Turks are also pointing at the fact that they would like to maybe see their EU membership progressing as a result of maybe a decision on Sweden. So there are lots of convoluted points around all of this. John, I think the bigger point here from the UK's point of view is making sure that the UK and the United States are aligned in terms of their thinking going into this meeting. The UK and the US collaborate on a whole range of other issues, including what happens in Asia, including the Five Eyes system of security and intelligence. There's lots of things going on here. It is significant that Biden came here first to make sure the ducks are basically in line before they progress to the NATO meeting.
And then on to a meeting with King Charles after meeting with Rishi Sunak. Guy Johnson, looking forward to your coverage, sir, in about 38 minutes' time, alongside Alex Steele on Bloomberg TV. Katie, thank you. We'll catch up with you, no doubt, a little bit later. King Charles III meeting with the President of the United States, and I'm told also with philanthropists and investors participating in a climate engagement a little bit later on. Something to look out for, perhaps. Coming up on this programme, the morning calls, and later, Samir Samana of Wells Fargo sounding the alarm on earnings just ahead of bank earnings on Friday, with Wells Fargo, Citi, JP Morgan just around the corner. Going into those numbers and going into CPI on Wednesday and PPI data on Thursday. Equity futures going absolutely nowhere. 3-day losing streak on the S&P 500. Will it become 4? We're pretty flat right now. From New York, your opening bell about 7 minutes away. Minutes away from the cash open. Equity futures just slightly negative. 3-day losing streak on both the S&P 500 and on the Nasdaq 100 too. Let's see if we make that day 4. That's the price action. Here's some morning calls. First up, Wells Fargo downgrading Fox to underweight, seeing elevated risk to the company's news viewership ahead of results. That stock is down by 1.6%. Your second call coming from the team over at Morgan Stanley, raising their Netflix price target up to $4.50 and growing increasingly bullish on its streaming business as it continues to gain market share. That stock is just a little softer, slightly negative by 0.08%. And your third and final call comes from the team at Evercore, downgrading Citizens Financial to inline, $29 price target, expecting accelerated loan declines and funding pressures to threaten quarterly results. We're down there by a little more than 2%. Coming up on this programme, Wall Street sharply divided as ever over the outlook for equities. After one of the best first halves on record, we'll catch up with Samir Samana of Wells Fargo. Coming up next, your opening bell just around the corner. 'The trading week officially begins in about 20 seconds' time. Going into it, equity futures slightly negative, softer, down by, let's call it 0.1% on the S&P. No real drama here whatsoever this Monday morning. On the Nasdaq 100, down about 0.1% as well. Losses through the back end of last week. Some losses this morning. We recover slightly going into the opening bell. There's the opening bell. Switch on the board and get to the bond market. Yields are looking at a little something like this on a 10-year, down a basis point to 4.05% on a US 10-year. The trend over the last few weeks, so the front end, yields up, up, up and away. 5 consecutive weeks of yields climbing at the front end of the curve. This morning, yields declining by 3 basis points on a 2-year to 491, on a 10-year to just a little north of 4%. The FX market, the euro, slightly weaker against the dollar, 109.60. We're negative there by not even 0.1%, and crude down by 0.7%, $73 and let's call it 30 cents. Let's call it 30 seconds into the session Your equity market shaping up as follows, down by not even 0.1% on the S&P and a little bit softer on the Nasdaq. One stock to watch at the open, Meta. The new social media app Threads topping 100 million users in less than 5 days. Evercore's Mark Mahaney saying this: we estimate that Threads can generate approximately $8 billion in annual revenue by 2025, generating almost $1.50 in incremental EPS, or 6 to 7% accretion to Meta's 2025 earnings per share. Abby has more. Hey, Abby.
Hey, John. And you can see that Meta is popping higher, up 2.3% now on the year, up more than 145%. This as Threads does have, over the last 5 to 6 days, 100 million subscribers, as you just talked about, putting it on pace to be the most downloaded app at a record pace, really even taking out ChatGPT. Apparently, ChatGPT, 100 million subscribers over 3 months. And as you just mentioned, Mark Mahaney over at Evercore is very bullish on this over the next 2 years, putting a number on it, $8 billion, and the idea that they could gain 200 million subscribers. Now, its competition, Twitter, of course, has more than 200 million subscribers already, but the threat of this is it could be a big piece of why Twitter last week did, of course, send a letter to Mark Zuckerberg, basically telling them to cease and desist. Now, if they were to pursue litigation, it would be potentially over trade secrets. That's a pretty vague area of the law. The hurdle would be high for them to prove. They'd have to go under the hood and prove that there was something happening there, that employees at Instagram and at Threads right now, Facebook, I should mention, Instagram saying that there are no Twitter employees on Threads, but they would have to make every effort to prove that that did not exist. But the other hurdle could be, has Twitter done everything that they potentially can to make sure that any secrets was really put in place, that there was some kind of Chinese wall put in place? Lots ahead, but right now we do clearly have Meta benefiting from this, up 2.5%, John.
That's just today. Abby, thank you. Today up 2.5%. Year to date up by 147%. Close to 150% higher year to date. That, by the way, the number 2 most performing stock on the S&P 500 year to date. You want the top 5. Number 1, Nvidia, up by about 193%. Number 2 is Meta. Number 3 is Carnival Cruises, up by 138%. Tesla, so far this year, up 125%. Royal Caribbean, up there as well. What is it about cruises? Up by more than 100% year to date. Those stocks are absolutely ripping in 2023. Let's turn to the auto sector. Rivian looking to extend its rally to a record 9th consecutive session. Better than expected production and delivery numbers fueling the stock's 80% advance since late June. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. The stock really bouncing around, swinging between gains and losses in the early part of this Monday session. We're softer by around 0.4% on Rivian. We were higher by as much as 3% following the open. It's kind of finding its feet and settling. If the stock closes higher, it will be a 9th consecutive session of gains, a record for Rivian. The stock has gained more than 84% in the last 8 sessions through Friday. But reminder, this is a stock that fell 82% in 2022. It was the second worst performer on the NASDAQ 100 and was actually removed from the NASDAQ 100 in May. The catalysts were a week ago production and delivery numbers for the quarter that beat analyst expectations. They also started to give some sense of progress on the electric delivery vans that they make for Amazon, their biggest investor. They've started rolling out a few hundred units to Europe in German cities. And in an interview with me last week, the CEO, RJ Scaringe, outlined that the reason they were able to do that is they built out the supporting infrastructure in Europe. We're now higher 0.4% and bouncing around, but it's a stock that's had a lot of attention of late, and it's kind of moving away from the large pack of other EV startups that have struggled to be real, get real volumes on production. And you'll see, actually, John, that in terms of analyst price targets, we are seeing the analysts start to catch up. I think the average 12-month price target right now on Rivian's $22.86. We're trading at $24.80 a share. The post-IPO peak in November 2021, $172.01 a share. We have a long way to go to get anywhere near that.
Just to build on those points, you know this management well. Is this real competition anytime soon for Tesla?
Yeah, look, the guidance for this year is 50,000 units across their 2 consumer products and the van that they make for Amazon. During the interview, RJ Scaringe said that around 20% of that volume will be the Amazon van. But on paper, the factory is capable of so much more. And I asked him, why don't you just raise guidance? based on the numbers, based on what the installed capacity is. And the response was, our aim is to exceed targets. And that has been a frustration for the street. They think that Rivian should be producing in far greater volumes. The question is, a pickup truck and an expensive SUV just a sort of niche corner of the market? And Rivian is staking its future on a mass market model called the R2 that won't go into production until 2026. That gives you a sense of how far away they are from being a bona fide mass market competitor.
Ed, let's just finish on the competition for Elon Musk elsewhere.
Sure.
Threads. How's Twitter responded to that?
Yeah, I mean, Elon Musk has taken to Twitter over the weekend. He's made a number of comments on Twitter, most of them directed at Mark Zuckerberg. Seeming to be humorous. We don't hear anything from Linda Yaccarino, the CEO, and there's been no sort of proposal on platform innovation to change anything about the platform that would ward off the competition from Meta. I think that's where the question is. What does Twitter do in response to make the platform better and therefore competitive and against the threat of what Threads is providing?
Interesting. Ed, looking forward to the coverage with you and Caroline Hyde a little bit later on today. Bloomberg Technology on Bloomberg TV in about 2 hours and 30 minutes time. For the broader market, about 6 or 7 minutes into the session, equities positive by 0.1% on the S&P, dead flat on the Nasdaq. Here's another mover for you. Icahn Enterprises surging at the opening bell. Carl Icahn and several banks finalising amended loan agreements that unite Icahn's personal loans from the trading price of his company stock. I should say unties those two things. Katie Greifeld has more. Hey, Katie.
Hey, John, this according to reporting from the Wall Street Journal, some needed breathing room for Carl Icahn just 2 months after Hindenburg Research, of course, disclosed that short selling report against his investment firm. Now, for context, Carl Icahn has borrowed billions of dollars against his share in Icahn Enterprises. And given that the stock has dropped about 40% or so since that short selling report came out, that had thoughts of a margin call on investors' minds. So we are seeing some relief there. You can see shares up nearly 12% at this moment. And just to get some more details, in addition to untying his personal loans from the share price, these amended agreements would also increase Carl Icahn's collateral and also set up a plan to fully repay the borrowings in 3 years, again, according to the Wall Street Journal. So shares currently up 11.5% at the moment. If this move holds, John, it would be the biggest rally in about 2 months.
Not bad. Katie, thanks for that. The latest on Icahn Enterprises, that stock doing nicely. We've just had the best first half on record, leaving strategists very split over where stocks are heading in the second half. There's a 50% difference now between Wall Street's most bullish and bearish year-end targets, marking the biggest mid-year gap in 2 decades. Joining us now to discuss, Samir Samana of Wells Fargo. Samir, wonderful to get your perspective on things. Which camp are you in? Which side of that split are you on?
Yeah, I guess we're on the more cautious side. And I think a lot of it has to do with, look, we appreciate the strength in the economy. And I think it'd be fair to say things are slowing probably a lot more slowly than people expected. I think the tricky part is the Fed's reaction function remains pretty much intact, which is they want inflation close to 2%. And there's almost only one way to get it there, which is to raise rates further than markets expect and leave them there longer than markets expect, which just means that the multiple that you're willing to pay for equities is going to be a lot lower than people anticipate.
Samir, the problem we've got is that pockets of this economy are doing badly. Pockets of this economy are doing well. Manufacturing's in recession. Services okay. If you look at the prices in the respective industry groups, goods prices softer. We know that story. It's been developing for a while. Services prices pretty sticky. Do you think a binary debate about a headline recession or not is the right approach to all of this?
No, actually, we would say, look, focus kind of on the bigger picture with respect to, are things slowing or are they getting better? And we would argue that although there's been some recent improvement, they will get worse into the back half of the year. What to us is more important in the, in terms of kind of the investing debate is what credit's going to do in the second half of this year. And we really do believe when you look at high yield spreads, when you look at investment grade spreads, you're not getting paid to take the risk there. And as those spreads start to blow out in the latter half of the year, that's what's going to be driving investment and asset pricing. It's not even going to be so much the economy. I think the tricky part is going to be that although you have credit spreads widening out, the economy at that point will probably also be hitting the skids. And I think the tricky part is all of those things will happen at the same time in kind of the second half.
Amanda Lynham of BlackRock talked about credit spreads a little bit earlier. High yield, as we know at the moment, is trading pretty tight. Pretty tight, so tight it's south of 400 basis points the last time I looked. Samir, when you use language like spreads are going to blow out, what kind of numbers are you thinking about?
So at least in previous, kind of recessions, you've seen numbers, kind of in the high, single digits, maybe even, just reaching double digits. We were just there not that long ago, and the fall of last year, I think we got close to 650. So in a true recession, it wouldn't surprise us if you're looking at 700 plus on spreads.
Where does that leave equities?
It leaves them lower, which is why our target continues to be 4,000 to 4,200. We've only made one revision this year. It was actually to the downside, again, having to do with the economy, which we do think will slow in the second half. And then, like I said, at one point we thought that maybe the Fed could get away with, kind of interest rates in this area. But now it seems like they may have to go a little bit further. So if you've already got earnings being pressured, and then the multiple, is also going to be pressured much more than we anticipated. Again, if I were to make a revision, I think it would probably be again to the downside. It's really difficult to see how things are going to play out better than markets anticipate from these levels.
The divide is amazing right now. If I take Max Kettner of HSBC and read his research this morning, it's almost the polar opposite of what you're telling me, Samir. He said this morning, that contrary to expectations, the first half proved to be a good half for risk assets, and we see little reason to change our risk on stance. He went on to say for the second half, we see risks around macro data running too hot, far from recessionary expectations. Samir, what would you say to the Max Kettners of this world?
I think the part that they're missing is if the data does continue to run too hot, you're probably talking about a Fed funds rate probably north of 6%. That is not going to be good for risk assets. I think the tricky part is the Fed is tightening, which is a leading indicator, right? That's slowly seeping into the economy as people kind of reset on their rates. I think the tricky part is the economy is a little bit of a lagging indicator in the sense that, again, those Fed funds hikes work with kind of those long and variable lags. So I think the tricky part for a lot of these folks is the too hot economy is kind of the lagging indicator. And if the Fed goes too far, by the time the economy slows, you're already going to have rates at too high levels, and the Fed's not going to be able to reverse course quickly enough.
Samir, let's say you're right. What do you like right now?
So we would continue to focus on larger cap equities. Until recently, we were favorable on tech. We took that off because, again, multiples probably are a little bit ahead of themselves. We like healthcare, we like energy, and we like materials. Energy and materials, it might take a little bit longer to play out, especially if there's a recession and China continues to slow. But we do think you get paid to take the risk there. We would continue to avoid consumer discretionary and real estate. Those are the parts of the economy that will probably be hit hardest by any slowdown. Within fixed income, we would also continue to play some defense. So we like the short end of the curve and the long end of the curve because we think you can lock in some of those yields. And then we would continue to avoid credit until you get to a place where those spreads are compensating you for the risk that you're taking.
Could you give me the geographic split as well? I read this from Citi this morning. They've cut their call on the US. They said this: our US strategy team thinks mega cap growth is set for a pullback. They said US recession risk could still bite. Sounds like you might be on the same page on that last point. They said we raise Europe back to overweight. Europe is once again trading at a record discount, should benefit from a weaker dollar and any stimulus out of China. Samir, where are you on the geographic split right now?
So we're US 1, we're developed markets 2, and we're emerging markets 3. We did recently upgrade developed markets from those unfavorable to neutral. So, if there is a little bit of resumption of kind of economic recovery in Europe or in China, we think that's the best way to play not emerging markets properly.
Do you think the data overnight from China opens the door to some stimulus?
I mean, the door's been open for stimulus for a long time. I think the tricky part is the currency keeps weakening, and the fact that the Fed has to go further, has got them a lot, worried about capital flight. So I think that's the tricky part is they're just kind of pinned in. It's one more thing that, I guess the implications of inflation running too hot in the U.S., those are kind of the global implications with respect to the Chinese can't really stimulate until the Fed's kind of done with their tightening cycle.
Oh, Samir, let's leave it there then. So you expecting China to hold off from any big-scale stimulus anytime soon?
Big scale, yes. Targeted, I think they'll keep doing some things around the edges.
Samir, thank you, sir. Appreciate the clarity on that. Samir Samana there of Wells Fargo Investment Institute on global markets and what he's expecting from China a little bit later this year, and on the Federal Reserve too. If you are just tuning in, welcome to the programme. About 15 minutes into the session, equities positive by 0.1% on the S&P, slightly negative on the Nasdaq. Coming up later this week, we have CPI on Wednesday, PPI on Thursday, and then we close out a week with earnings. Up next on this programme, investors looking ahead to big bank results.
Bank earnings are going to continue to show a challenged outlook. You have, from the deposit side, banks are needing to pay up to shore up their deposits. And on the lending side, you are seeing lending growth slow.
JP Morgan, Wells Fargo, Citigroup kicking off earnings season on Friday. We'll get you a preview with Shnali Basak up next.
Bank earnings are going to continue to show a challenged outlook. You have from the deposit side, banks are needing to pay up to shore up their deposits. And on the lending side, you are seeing lending growth slow. In our baseline scenario, S&P 500 earnings below trend for 3 years, 2021, 2022, 2023.
Investors gearing up for a crucial earnings season following the best first half on record. Wall Street forecasting a 9% drop in Q2 profits, the biggest year-over-year decline since 2020. Morgan Stanley's Mike Wilson writing, quote, with earnings beginning this week, better than feared results likely isn't going to cut it anymore. The team at Goldman taking a different view on things, writing, we expect companies will be able to meet the low bar set by consensus. Negative EPS revisions for 2023 and 2024 appear to have bottomed, and revision sentiment has improved. All this as the attention turns to the big banks, with JP Morgan, Wells Fargo and Citi due to report results on Friday. Joining us now with a preview, who else? Shonali Basak. Hey, Shonali.
Good morning, John. When you take a look at the biggest banks, the things that were making big money in the last couple of quarters, you're seeing that start to subside. That is the trading desk, which had brought in a lot of money in 2020, 2021. Listen, now you're looking at Goldman Sachs saying that it could drop by about 25%. JP Morgan saying about 15%. Bank of America is holding up better than many with about a flat expectation here. But some of the investment banking businesses here are now spilling over into troubles in trading. Now, when you take a look at the lending side, also there's a question here about whether net interest income needs to be revised. Loan demand across the industry has been quite sluggish. So remember, these lending books across all the different banks look very differently. We have had Wells Fargo recently downgraded over at Wolfe Research because of that commercial real estate footprint, because of that mortgage footprint. So it's going to be choppy across all the big six banks. The question is, are there revisions into the second half of the year that will read through into what the banking picture looks like into next year? And that has nothing to say for the regional banks. That could show more choppiness, given that we've had deposit flight that has only continued throughout the quarter.
Well, let's get the update on that, Shonali. 3 months ago, there was a very different approach to this sector. This was it. It was all about the banks reporting, not just the big ones, but the regional ones more specifically. What's the approach to earnings season this time around?
Listen, the bigger banks, particularly with the trading desks, have held up so much better than those big consumer banks. But now that you see this quarter, those troubles starting to eke into those numbers, and remember, even among the trading desks, they all have very different footprints. Goldman, for example, heavy in commodities. That's a very different story in commodities this year than it was last year. And so if you're not making the money in those kind of big money trading businesses here, where are you making money, I think is the question going into the second half of the year into next year.
Shonali, thank you. Looking forward to it. Shonali's coverage ramping up on Friday. We'll touch base with Shonali ahead of that, no doubt, on Friday to go through it again. Goldman, Wells Fargo, Citi, then on to all of the rest through next week. Let's get you some sector price action. Let's get to Abby.
Hey, John, and the sector action today is super interesting. We have the S&P 500 up fractionally, but more sectors than not are higher. In fact, industrials up by 1%, healthcare up by about 0.8%. That's the same deal for staples. Financials up 0.5% to 0.6%. So lots of strength there. But on bottom, you have those heavyweight tech sectors. Those are the three sectors that are down. That is the big weighting to the index. Let's just call it 25 to 30%. So you have the index basically flat and unweighted. There is one area of technology that is flying higher today, though, and that is the chip sector. That stock's up about 0.8% on the year, up an amazing 42%, heading to its best year since 2020. And this, of course, has to do with Taiwan semi-manufacturing, a good number. They beat estimates, John, in their quarter, having a lot to do, of course, with that AI demand boost that's helping out a lot of the chip makers.
Abby, thank you. Nasdaq slightly softer this morning. S&P 500 is just a touch firmer. Positive by, let's call it 0.1%. On the S&P 500. Your trading diary up next. Four days of losses on the Nasdaq 100. Haven't seen that many times this year, given the rip-roaring rally we've seen on that index so far year to date in 2023. So far this year on the S&P 500, double-digit gains this morning, positive by not even 0.1%. That's the equity picture. I just want to finish on the bond market story just quickly. 2s, 10s, 30s. Yields just a little bit lower this morning at the front end by 3 basis points. Let's call it 491 on a 10-year, just about holding on to 4%. Yields lower there by a single basis point. That's the price action. Let's get to the trading diary. Coming up, Fed Vice Chair for Supervision, Michael Barr speaks in about 10 minutes time. Plus, we'll hear from Daily Mr. Bostic throughout the rest of today. The 74th NATO summit kicking off tomorrow. CPI coming up on Wednesday, followed by initial jobless claims and PPI on Thursday. And then we get the big banks reporting on Friday. JP Morgan, Wells Fargo and Citi just around the corner. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day and the trading week for that matter. This was the countdown to the open. This is Bloomberg.